Welcome back to The Deep Dive, the show dedicated to turning dense financial and scientific source material into thoroughly digestible yet sophisticated knowledge. Today, we are diving deep into what is probably the single most important and perhaps most feared metric in all of finance: volatility.
It really is. It's the engine of market movement, the source of both panic and opportunity. But so many people still use the term really loosely, equating volatility simply with risk.
Right, just a general sense of danger.
And that's a very reductive view. Volatility is far more precise than that. It is fundamentally the degree of statistical variation in trading prices over a specified period of time.
And if you've ever been an investor, whether you're managing a small personal portfolio or running a massive hedge fund, you have absolutely felt volatility. That surge of anxiety when you check your account right before bed, or the euphoria when a stock unexpectedly pops 10%.
That's it in action. That feeling is the emotional response to volatility. This one concept governs pretty much everything, from how financial institutions price incredibly complex derivatives like options to the emotional discipline required just to stay invested for the long term.
So our mission for this deep dive is to give you, the listener, a really comprehensive and actionable understanding of this concept.
Exactly. We're going to go well beyond the textbook definition, the standard deviation of returns, to explore the precise financial language that practitioners actually use. We'll analyze the different types of volatility. We'll look at the surprising mathematical rules that dictate how price dispersion expands over time. And finally, we will tackle the profound philosophical critiques raised by industry legends about why even the most complex forecasting models, why they often fall short.
Okay, so let's nail down the big picture definition first. What exactly are we measuring?
We are measuring dispersion. That's the keyword. In finance, volatility, which is nearly always denoted by the Greek letter sigma, is the degree of variation of a trading price series over time. And crucially, the standard industry measure is the standard deviation of the asset's logarithmic return.
Okay, let's pause there. Why logarithmic returns specifically, not just standard percentage returns?
It's a great question because it gets right to the heart of financial math. Finance deals with compounding. When you calculate returns with standard arithmetic, a move from 100 to 110 is 10%, but a move from 110 to 120 is only 9.09%.
Even though they're both $10 increases.
Exactly. Logarithmic return or log returns, they normalize these movements. It allows you to treat returns as additive over time, which makes the statistical analysis, particularly when you're trying to annualize things, much, much simpler. It's just a more accurate picture of continuous compounding.
And for a real-world anchor, a concept the listener has certainly heard of, we have the VIX.
The CBOE Volatility Index, or VIX, is probably the most famous real-time representation of this concept, but it's not calculated from historical prices. Instead, it measures the market's expectation of volatility over the next 30 calendar days.
And gets that from option prices?
It's derived from the prices of S&P 500 index options, yes. It's often called the fear gauge because it acts as a real-time index of implied volatility. When that number spikes, it signals a market consensus of extreme uncertainty and high expected variation.
It's fear, math, and opportunity all wrapped up in a single famous ticker. Okay, let's unpack the terminology because this is where many people get lost. Volatility is often used as this kind of catch-all term, but our sources show it's rigidly categorized. It splits into two main branches, actual and implied. And understanding this split is, it's foundational to any kind of advanced trading.
It really is. And the key differentiating factor is just the direction of observation in time. Are you looking backward or are you looking forward?
Okay, let's start with the rear view mirror, actual volatility.
Actual volatility, which is often just called historical volatility, is purely backward looking. It's a measure of fact. It's based on a time series of past market prices. So if you are calculating the standard deviation of Apple's daily returns over the last year, you are calculating its actual volatility. It's something that has already happened.
A known quantity. Conversely, we have the predictive element.
And that's implied volatility. It looks forward in time. It is not calculated from the asset's past price movements at all. Instead, it is derived or implied from the current market price of a specific derivative, specifically a traded option.
How does that work? How is it implied?
Well, the price of an option inherently contains the collective market's consensus expectation of how volatile the underlying asset will be between now and the option's expiration date. So what we do is we take the famous Black-Scholes formula, we plug in the current option price, and we solve it backwards to find the one unknown variable, the implied volatility that justifies that price.
So, actual volatility is a calculated certainty, a known historical fact, whereas implied volatility is the market's current best guess about future price dispersion.
Exactly. A perfect summary. And even within that backward-looking data, the term actual volatility has three specific dimensions, depending on the time frame we're looking at. Practitioners need this level of precision.
Right, so let's detail the first of those three, actual current volatility.
This refers to volatility that's calculated based on historical prices over a very specified recent period, say the last 30 or 90 days. The crucial element here is that the last observation in the data set is the most recent price, like today's close. You're trying to gauge the immediate past market environment leading right up to this moment.
Like a moving window that ends right now.
Exactly.
Yeah.
Now, the second one is actual historical volatility, which you'll also hear called realized volatility.
Okay, how is that different from what you just said?
It's conceptually identical, but the specified period ends on a date in the past. So maybe you want to analyze market behavior specifically during the 2020 COVID crash for the period ending on, say, April 1st, 2020. That's historical volatility. The term realized volatility is used a lot, especially in academic papers, and it's technically defined as the square root of the realized variance. It's just the measure of how much price variation actually occurred over some specific past interval.
Got it. And the third, which must always be stated with the caveat that we can't actually know it yet, is actual future volatility.
This is the unknown target. This is what everyone's trying to predict. It's the measure of the volatility of a financial instrument over a specified period starting now and ending at a future date, say the next option expiration cycle 3 months from now. We can only know this number when that future date finally arrives, which is why we spend so much time and energy trying to predict it using all the other types of volatility.
Right. Now we flip to the forward-looking side. Implied volatility. So if actual volatility looks at past, present, and future periods using historical prices, then implied volatility looks at those same three time points, but through the lens of options prices.
Precisely. Implied volatility is observed from the options market, and we categorize it simply by the point in time we observe the options prices themselves.
So the first is historical implied volatility.
This is the implied volatility you would get by looking at options prices that existed on some historical date. It doesn't tell you what the stock actually did, it tells you what the market expected the stock to do back then. For example, if you wanted to see the level of fear right before the 2008 election, you look at the historical implied volatility of options that were trading in, say, September of 2008.
That's fascinating. And the second, and probably the most operational term for traders, current implied volatility.
This is what most people mean when they just say implied volish. It's the implied volatility derived from the options prices that are trading right now at this very moment. This is the VIX number, or the standard figure you'd see in a trader's model. It represents the market's real-time consensus forecast for future price dispersion over the life of the option.
Okay, and finally, the most abstract one, future implied volatility.
This refers to the implied volatility observed from options prices that won't even exist until some point in the future. We often observe this indirectly. If you buy a complex derivative known as a volatility swap or a swaption, you are essentially making a trade today on the implied volatility that the market expects to see at some future date.
So it's the market's expectation of future fear.
A great way to put it, it's a second-order derivative.
That is a fascinating taxonomy. But why is it so crucial for our listener to hold these 6 terms straight? What is the practical application?
The application is the entire prediction game and the search for value, for mispricing. You see, investors often make the basic mistake of using historical actual volatility as their only input to predict actual future volatility. They just assume inertia. They think, well, the past 90 days were stable, so the next 90 days will probably be stable too.
Which is often a terrible assumption right before a major event, like an election or an earnings call.
Exactly. But if you look at the current implied volatility and you see that it's significantly higher than the actual current volatility, that divergence is a massive flashing warning sign. The market consensus priced into the options is telling you, we expect things to get much, much wilder than they have been recently. That signal gives you a crucial risk management shortcut, and it helps you identify potential market mispricing or an unappreciated upcoming event.
You're essentially comparing objective realized data against the collective forward-looking market sentiment.
Precisely. And the difference between the two is where traders make their money.
Now we move into the cold, hard math. This section is where we strip away the psychology and establish the fundamental rules governing price movement. At its core, we said volatility is the statistical standard deviation of the logarithmic returns, but we have to standardize this measure to make it comparable across different assets and time frames.
And the standard comparable measure that we use is annualized volatility. That's the key term. You'll see it written as sigma annually. This is defined as the standard deviation of an instrument's expected yearly logarithmic returns. This annualization process is absolutely essential because, daily volatility looks tiny, monthly volatility is small, but the yearly measure provides a consistent benchmark for risk management.
So you can compare the risk of a stock to a bond to a currency, all on the same scale.
Exactly. Regardless of how frequently it trades or the length of the holding period you're analyzing.
And this standardization process brings us directly to a principle that often surprises people who are new to finance, the square root of time rule. Our sources confirm that if an asset's returns follow a Gaussian random walk, which is the big simplifying assumption in the classic Black-Scholes model known as a Wiener, process volatility does not increase linearly with time.
This is one of the most powerful and counterintuitive ideas in quantitative finance. While the price dispersion does increase over time, making it more likely for the price to stray farther from its starting point, that dispersion increases only with the square root of time.
Okay, we need to spend some time on the intuition behind this. Why the square root? Why isn't 10 days of volatility simply 10 times the daily volatility?
Think about the nature of randomness. Price movements, especially in very liquid markets, are somewhat independent from day to day. If the price goes up 1% today, it has a roughly equal chance of going down 1% tomorrow. So if you aggregate 100 days of movement, you shouldn't assume that all 100 days moved in the same direction.
Right. There's a high probability that some of those fluctuations will offset or cancel each other out over longer periods.
It's the expected chance of reversal that dampens the aggregate movement.
Yeah.
It's like flipping a coin repeatedly.
Oh?
Well, if you flip a coin 4 times, the expected range of outcomes for heads minus tails is much, much less than 4 times the range of flipping it just once. Why? Because the results are likely to partially negate each other. The net effect is that the most likely deviation after twice the time will be only the square root of 2 times the original deviation, not twice the deviation.
That makes sense. And the generalized formula reflects this elegant, nonlinear scaling. The volatility over a time period t is the annualized volatility multiplied by the square root of time t, where t is measured in years. This is the essential bridge between short-term noise and long-term risk.
And this principle is applied operationally every single day when we perform the necessary step of annualizing daily returns.
So we take our daily volatility, let's call it sigma daily, and we convert it into the standard yearly number, sigma annually. The formula is sigma annually sigma daily squared PSP, where P is the number of trading days in a year. And the source highlights the common assumption for P.
In North American and many global markets, the standard assumption for P is 252 trading days per year. This accounts for 52 weekends and the major national holidays. You'll sometimes see 250 or 260 used, but 252 is the most robust industry convention.
Let's run the concrete example provided in our source material, because this really drives home the power of the square root rule. Say we observe an average daily volatility, a standard deviation of daily log returns of 0.01 or 1%. What does that look like when it's annualized?
So using our formula, sigma annually equals 0.001 times the square root of 252. The result is approximately 0.1587. So that seemingly tiny 1% daily fluctuation translates into an annualized volatility of 15.87%.
That is a staggering amplification of risk perception based purely on the time horizon. If someone just naively multiplied 1% by 252 days, they would erroneously conclude the annual volatility was 252%.
Which is absurd, right? That linear calculation vastly overestimates the expected dispersion, and it really underscores why the square root rule is absolutely mandatory. It's the difference between assuming that every single day will compound perfectly in one direction without any reversals versus the statistical reality of a random walk.
Now, for the real world, where we often need quick estimates without a calculator, we have the famous shortcut known as the Rule of 16.
The Rule of 16 is fantastic for back-of-the-envelope calculations, but it's critical to understand its limitations. The rationale is purely convenience. 16 is the square root of 256, which is an extremely close round number approximation of 252 trading days.
So if you read a news story that an asset index moves about 100 points on average each day, and the index is near 10,000, which is a 1% daily move, you multiply 1% by 16 and quickly estimate 16% annual volatility. It's fast, simple, and satisfyingly close to the mathematically precise 15.87%.
It's great for that. But the source material provides a crucial warning. This is a crude estimation. It is not a statistical calculation.
Why is it crude specifically? What does it miss?
Well, a few things. First, it often relies on the average magnitude of observations, essentially the average daily price range, rather than the statistically derived standard deviation of returns. And the standard deviation, by its very definition, captures the influence of those extreme, infrequent daily movements, the outliers, because it squares the differences from the mean. The Rule of 16 often fails to properly account for those massive single-day moves.
So the shortcut is structurally biased against capturing tail risk. It misses the big crashes and the big rallies.
Exactly. And furthermore, just from a pure math perspective, assuming a normal distribution with a mean of 0, the expected value of the magnitude of observations is actually slightly less than the true standard deviation. The combined result of these approximations is that the crude Rule of 16 generally underestimates the true volatility by about 20%. It's a great starting point for intuition, but you should never use it for, say, pricing an option.
And this brings us to the most significant flaw in traditional financial modeling, which is the assumption we've been relying on this whole time. The Gaussian model.
Yeah.
We have to go beyond the Gaussian model because the real world does not follow a perfect bell curve.
This is the source of endless frustration and risk for quants and investors alike. All the standard formulas, the square root rule, the calculation of the 95% return range, they all rely on the assumption that price changes follow a Gaussian or normal distribution. But empirical evidence confirms over and over again that observed price changes are often leptokurtotic.
Let's dedicate an exchange to defining that term clearly for the listener. What does leptokurtotic mean?
It's a fancy term for having fat tails. Think of a standard bell curve. The tails on the far left and far right represent the extremely rare events, the 2, 3, or 5 standard deviation moves. A normal distribution predicts that a 5 sigma event, a massive, catastrophic move, should happen something like once every several million days, maybe once every few thousand years.
And what do the fat tails of real-world financial data tell us?
They tell us that those extreme, infrequent movements happen much, much more often than the normal distribution predicts. Crashes, bubbles, massive single-day jumps or drops. These events are fundamentally more probable in financial markets than the clean Gaussian math allows for. So if the model says a 10% drop should happen once every century, the fat tails are telling us financially that it might happen once every 10 or 20 years. This mismatch between theory and reality is why risk management models often underestimate catastrophic risk.
It's a crucial insight. So how do sophisticated models try to capture this reality?
Well, they have to turn to alternative statistical frameworks. For instance, the Levy distribution, specifically the Levy alpha stable distribution, is often used. These models are built to accommodate processes where large jumps are more frequent, and the standard deviation might even be technically infinite. The famous mathematician Benoit Mandelbrot found that when he was analyzing cotton prices, the data perfectly fit a Levy alpha stable distribution with an alpha value of 1.7.
And you need an alpha value of 2 for the standard predictable Wiener process, the random walk.
Correct. The fact that financial markets often exhibit an alpha of less than 2 suggests that market movement is significantly less predictable, potentially infinitely more volatile, and certainly much, much messier than the clean classical financial formulas suggest. This realization is what drives the constant search for better modeling techniques.
We've established the math, but the sources we reviewed noted a critical point. Despite decades of research and complex modeling, very few theoretical models truly explain how volatility originates in the first place. What actually causes price variation day after day?
Yeah, the focus has shifted over time from macroeconomics to what's called market microstructure, which is the study of the mechanics of trading itself. Roll, back in 1984, provided some of the early evidence that volatility isn't just an inherent property of an asset, but it's actively affected by the specific rules and mechanics of how the market operates, how orders are placed, how prices are quoted, the timing of information flow.
And then Glosson and Milgram in 1985 gave us a very granular explanation for one specific source, the liquidity provision process.
This is where we see the fear element quantified. Liquidity is provided by professional market makers who have to constantly stand ready to buy at their bid price or sell at their ask price. They are the essential lubricant of the market, but they operate under the constant threat of adverse selection.
And that's the fear of being taken advantage of by someone with better information, someone who knows for sure the stock is truly undervalued or overvalued.
Precisely. If a market maker suspects there's a high probability they are trading with a better informed party, which is common during periods of political turmoil, regulatory uncertainty, or right before an earnings report, they have to protect themselves. They do this by widening the difference between their bid and ask price. They increase the bid-ask spread.
And that widening of the bid-ask spread directly translates to an increase in volatility.
Absolutely. The wider the spread, the larger the band of price oscillation is for the next trade to occur within. Volatility, in this context, becomes less an abstract mathematical measure and more a quantifiable symptom of information asymmetry and collective nervousness among the professionals who facilitate trading. It's their insurance premium against being blindsided.
And sometimes that information asymmetry, or just general uncertainty, comes from truly external sources. We have a fantastic modern anecdote that captures this exogenous nature of some volatility, the Volfefe index.
Yeah. Oh, this story is fantastic because it bridges political science and quantitative finance. In September of 2019, analysts at JPMorgan Chase developed the Volfefe Index, a play on volatility and the Kafet typo meme, specifically to track the correlation and effect of U.S. President Donald Trump's tweets on market volatility.
What were they actually quantifying? What did the index measure?
They quantified two things: the frequency of the tweets and also the subject matter, for example, if it was about trade, the Fed, or China. And they found a statistically significant link between the frequency and content of the president's social media activity and immediate short-term market variation. A sudden, unexpected tweet on trade policy caused market makers to instantly widen their spreads due to this new, unexpected information.
And that translated directly into a measurable spike in both realized and implied volatility.
It showed that a single political figure's social media feed could become a primary source of microstructure volatility, forcing quantitative models to incorporate real-time linguistic analysis into their forecasts.
That's incredible. Okay, so that's the genesis of volatility. Let's pivot and look at the consequence for the listener. Why does this deep dive matter for the individual investor? Our source lists 7 distinct, profound reasons why volatility is central to investor decisions and portfolio construction.
These points move the discussion from the theoretical realm of the quant desk right into the practical implications for every single person managing capital.
Okay, number 1, the emotional impact.
This is pure behavioral finance. An asset with high volatility tests the discipline of the investor. It's that simple. Wider, faster price swings make it profoundly harder emotionally to stick to a long-term plan. People are naturally loss-averse, and volatility exploits that aversion, often leading to panic selling at the absolute bottom or chasing gains at the top.
Number 2 is about position sizing.
Volatility is the primary determinant of risk. Therefore, it dictates how much capital should be allocated to any given security within a diversified portfolio. The principle is really clear. If an asset has high volatility, you must hold a smaller position in it to maintain the same overall risk contribution to your total portfolio as a more stable asset would have. This is risk budgeting in action.
Number 3, shortfall risk.
This is critical for anyone with a known fixed liability coming up in the future. If you need cash flow at a specific future date to pay for, say, a child's college tuition, higher volatility means there is a much greater chance that the portfolio's value will fall short of that required amount when the deadline arrives. Volatility introduces uncertainty into meeting fixed obligations.
Number 4, retirement savings during the accumulation phase.
While you're saving and contributing to your retirement accounts, higher volatility means a wider distribution of possible final portfolio values. Now, while you do have a higher chance of ending up significantly wealthy due to large positive swings, you also face a higher probability of ending up significantly poorer. Volatility increases the planning uncertainty for your retirement goals.
And that leads right into number 5, post-retirement impact, which is sometimes called sequence of return risk.
This is perhaps the most devastating practical impact. Once you are retired and taking regular withdrawals, high volatility, particularly early in your retirement, can permanently damage your portfolio. If the market suffers a sharp drop, high volatility, and you are forced to withdraw funds at that low point, you compound the loss and significantly reduce the capital base needed for future recovery. This sequence of return risk is primarily driven by volatility.
Number 6 is the other side of the coin, the concept of informed opportunity.
Right. For professionals and those with superior information, volatility is a feature, not a bug. It presents opportunities to acquire assets cheaply when the price is depressed due to temporary noise and fear, or to sell them when short-term enthusiasm pushes them way above their intrinsic value. Volatility creates the pricing inefficiencies that active traders are always looking to exploit.
And finally, number 7, we come back to options pricing.
This is the hard mathematical cornerstone. Volatility is the single most critical, unobserved parameter in option pricing models, most famously the Black-Scholes model. A higher expected volatility directly means a higher option premium, because the increased price dispersion increases the statistical probability that the option will finish in the money and be valuable at expiration.
To really cement the separation of this concept from the simple idea of price movement, let's focus on the crucial distinction: volatility versus direction. Volatility measures dispersion, not the direction of the price change.
This requires a clear understanding of the standard deviation calculation itself. Because the formula involves squaring all the differences from the mean, all movements, negative and positive, are converted into a single positive, non-directional quantity. An asset that rockets up 10% one day and then plunges 10% the next, with a net return of near zero, is highly volatile.
The illustrative example provided in the source makes this distinction incredibly clear. Let's compare two hypothetical stocks, stock A and stock B. Both have the exact same expected average return, let's say 7% annually.
But their risk profiles are wildly different. Stock A has a low annual volatility of 5%, while stock B is highly volatile with 20% annual volatility.
Now, we use the normal distribution assumption to calculate the 95% return range, which means that the expected outcome falls within 2 standard deviations of the mean, and the difference is staggering.
For stock A, the 95% range runs from approximately 7% minus 2 standard deviations, so 10%, to 7% plus 2 standard deviations. That's a very contained range, from negative 3% to positive 17%. The returns are relatively predictable.
But for stock B, the high volatility asset, the 95% range runs from 7% minus 40% to 7% plus 40%.
Which gives you a 95% return range spanning from negative 33% to positive 47%. A range that large means a high volatility asset is essentially a coin flip between euphoria and absolute despair. Volatility is the measure of that range of possible outcomes, independent of whether the expected average outcome is positive or negative.
And we must immediately remind the listener of the caveat we covered earlier. This calculation assumes a clean, normal distribution. In financial reality, those returns are leptokurtotic fat-tailed.
Therefore, the probability of those extreme downside events, like a 33% loss or even worse, is actually more likely than this simple calculation suggests. Volatility, as measured by standard deviation, is thus often an optimistic estimate of the true tail risk.
We now enter the territory of modern quantitative finance, which was built entirely on the failure of a fundamental assumption. The classic Black-Scholes equation, the cornerstone of options pricing, assumes predictable, constant volatility. Empirically, we know this is completely false. Prices do not move with a consistent sigma.
That failure necessitated a revolution in modeling. Volatility changes, and it changes dynamically, meaning the risk profile of an asset is not fixed. This led to all sorts of models designed to address that reality. Local volatility models developed by Derman, Connie, and Dupire, models incorporating what are called Poisson processes to account for sudden, unexpected volatility jumps, and the widely used stochastic volatility models, like the Heston model, where volatility itself is treated as a random variable, exhibiting its own unpredictable movements.
And the most commonly observed empirical pattern in market dynamics is the concept of volatility clustering.
This is a fundamental law of finance discovered by Robert Engel, who won a Nobel for it. Assets experience distinct periods of high volatility, where prices whipsaw quickly up and down, followed by distinct periods of low volatility, where prices barely move at all. And crucially, these periods are sticky. High volatility tends to follow high volatility, and low volatility tends to follow low volatility. It implies that the magnitude of recent price movement contains information about the magnitude of near future price movement.
So the market gets into a rhythm, whether that rhythm is chaos or stability.
Yes, exactly. And our sources also note that in certain markets, these dynamic changes exhibit seasonality and presaging movements.
Where is seasonality most evident?
In the foreign exchange, or Forex market, price changes are seasonally heteroscedastic, which is a long way of saying the volatility patterns follow predictable, recurring rhythms over one day and one week. For instance, volatility often spikes right after the opening of the London or New York trading session when new information hits the market.
And this seasonality feeds into the theoretical concept of autoregressive conditional heteroscedasticity, or ARCH.
ARCH is the formal recognition that extreme market movements, a crash or a bubble, don't just appear spontaneously out of nowhere. They are often presaged by a period of larger than usual preceding movements or by a buildup of known uncertainty regarding specific future events. Think of the week leading up to a major geopolitical vote or a Federal Reserve interest rate announcement. Volatility usually creeps up beforehand as the market prices in that uncertainty.
So ARCH models can tell you when the market is about to get significantly more active or volatile.
They can tell you when the distribution of outcomes is about to get wider. But this is the critical limitation. ARCH and its more advanced cousin, GRCH, are fundamentally models of dispersion. They tell you very little about whether the subsequent large movement will be a sharp move up or a sharp move down. Prediction of volatility is far easier than the prediction of direction.
We also have the subtle but important phenomenon known as the resolution problem. This reminds us that how we measure volatility is highly dependent on our instrumentation.
A volatility measure depends not only on the total period measured, say, the last 30 days, but profoundly on the time resolution you use. Are you calculating returns from minute-by-minute ticks, hourly intervals, or just daily closing prices?
And why does that choice of interval, the tick size, create such a measurable difference in the final volatility number?
Because the flow of information is asymmetric across different timescales, short-term, high-frequency traders focus intensely on minute-by-minute noise and order book fluctuations, and that generates high-resolution volatility. Long-term institutions might only care about daily or weekly movements. High-resolution volatility contains information, the noise of intraday trading, that low-resolution daily volatility misses entirely. And conversely, low-resolution volatility might smooth out intraday noise, revealing longer-term structural trends that the minute-by-minute data just obscures.
So volatility is fundamentally a scale-dependent measure. There's no one true number.
Exactly. This inherent complexity forced options traders to develop tools that move beyond simple standard deviation for forecasting. They introduced a crucial distinction: clean vol versus dirty vol.
Okay, this sounds like a practitioner's tool.
It is. It's a sophisticated segmentation used for accurate option pricing, which divides the forecast of future volatility into two specific components based on the cause of the dispersion.
So clean volatility is the baseline noise.
Yes, it represents the routine expected noise. It's the volatility caused by standard daily transactions, general market flow, regulatory noise, and the constant predictable stream of small, non-event-driven information. It is the persistent underlying level of dispersion that would exist even without a major announcement looming.
And dirty volatility, or event vol, is the explicit risk factor for a specific event.
This is the volatility caused by specific, scheduled, or sometimes unexpected events. For instance, consider a major pharmaceutical company. Their clean vol is caused by routine trading, but their dirty vol is caused by the date of a major FDA drug trial result announcement, a sudden patent ruling, or a quarterly earnings call. These events are known to cause massive price jumps or drops.
So let's walk through a scenario. If I am pricing an option that expires the day after a pharmaceutical company's massive drug trial results are announced, the option price must factor in a disproportionately large amount of dirty vol, correct?
Absolutely. The option pricing model has to isolate the clean vol for the days leading up to the announcement and then spike the volatility input dramatically for the period covering the event itself. It's essentially isolating the jump risk into the dirty vol component. The core job of fundamental analysts at option trading firms is to translate qualitative news like the expected success or failure of a drug trial into a precise numeric value for the dirty vol component so they can accurately price options that straddle that known uncertainty.
This shows how volatility modeling moves from pure statistics into the analysis of fundamental, company-specific, or even geopolitical events. We now transition to perhaps the most humbling and expensive concept for the individual investor. The mathematical reality that volatility doesn't just mean bigger swings, it acts as a constant measurable drag on long-term portfolio performance.
Yeah.
This is the volatility tax.
This is often referred to as a drag on the compound annual growth rate, or CAGR. It's a mathematical consequence of compounding returns. If you achieve an average arithmetic return of, say, 10% per year, but that return is achieved with high volatility, your actual compounded return over time will always be lower than 10%. Volatility imposes a financial cost.
Let's explain the mechanism intuitively. Why is the impact of a loss greater than the impact of an equal gain when you're compounding?
It's asymmetry. If you start with $100 and you lose 50%, you're left with $50. To get back to your original $100, you don't need a 50% gain. You need a 100% gain on your remaining $50. The mathematical impact of a negative percentage change is always greater than the impact of an equal positive percentage change. The higher the volatility, the more frequently you experience these large swings, and the more often you are mathematically forced to earn a larger return just to get back to even. That asymmetry is the volatility tax in action.
And the simplified approximation for quantifying this drag uses the Taylor series expansion.
Right. The standard estimation is that the CAGR is approximately equal to the average return, or AR, minus the volatility tax term, which is 1/2 sigma squared. That term, T-frac 1/2 sigma, is the direct quantification of the tax. So if an asset averages a 15% return with 20% volatility, the tax is 0.5 times 0.2 squared, or 0.5 times 0.04, which is 2%.
So the effective CGR drops from 15% to 13%.
And 2 percentage points a year doesn't sound like much, but over a 10 or 20-year investment horizon, that 2% annual drag compounds significantly, eating into the total final portfolio value.
It's devastating over the long term. And unfortunately, that simple Taylor series approximation is, once again, often overly optimistic.
It is. The formula is too optimistic in the real world.
And that's because of those fat tails and negative skewness we discussed.
Exactly. Most financial assets tend to have more large negative movements than large positive ones. That's negative skewness. And the tails are thicker than normal, which is leptokurtosis. Therefore, the actual drag imposed by real-world volatility and tail risks is usually greater than the simple 1/2 sigma squared calculation suggests.
So practitioners need to adjust this formula for reality.
Yes. Industry practitioners often use an empirical factor, let's call it K, in the formula to adjust the sigma squared term. And given the observed tendency of real assets to be riskier than predicted, K values typically range from 5 to 10, which vastly increases the calculated volatility tax to account for the true cost of those large, frequent downside shocks.
Moving on, we tackle a highly contentious area, critiques of forecasting models. Despite the massive intellectual investment in developing models like JRCH, RHEJ, and stochastic volatility frameworks, there is an ongoing and profound debate about their true predictive power.
The skepticism comes from a very simple yet powerful claim that these incredibly complex, highly parameterized models often have predictive power that's similar to just plain vanilla measures, like simply using the past, or actual volatility we calculated back in Section 1.
So all that complexity yields no measurable edge.
That is the skeptic's argument, especially when they're tested out of sample. And that testing method is crucial. You train the model on one period of data, and then you test its forecast accuracy on a completely separate later period of data that it has never seen before. When subjected to this rigorous testing, critics argue that the complex JRCH models often fail to provide a statistically significant out-of-sample forecast improvement over simply using, say, the last 30 days of realized volatility as your prediction.
But I understand this debate is far from settled.
Oh, it's not. The counter-argument from the model proponents is that the studies claiming failure are flawed. They suggest that the critics failed to correctly implement the more complicated models in their testing. The implication is that JRCH models do offer superior predictive capability, but only when they're correctly specified and used by experienced professionals. The debate really boils down to whether the complexity is inherently flawed or whether it's just too difficult to implement correctly and consistently across all market conditions.
Regardless of who is right in the JRCH debate, the sources reveal a deep philosophical disillusionment with volatility modeling among some of the sharpest minds in the field. This brings us back to the human element and the limits of our knowledge.
This skepticism is perhaps the most humbling takeaway for anyone entering quantitative finance. Nassim Taleb, who dedicated his career to understanding high-impact, low-probability events, famously titled one of his foundational papers with the statement, "We don't quite know what we are talking about when we talk about volatility."
That title alone suggests that even the most rigorous mathematical definition of volatility only captures a fraction of the underlying market reality. What was his central critique?
Taleb argues that traditional measures of volatility are too reliant on the Gaussian framework, precisely because they fail to correctly account for those fat tails. We use a metric that assumes predictability and bounded risk, but the financial world, which is driven by human behavior, is fundamentally subject to sudden, extreme, nonlinear shocks. He contends that our mathematical definitions give us a false sense of security and control.
And Emanuel Derman, another figure central to the creation of modern Wall Street models, shared a similar disillusionment, focusing on the distinction between theory and metaphor.
Derman expressed fatigue with the enormous supply of empirical models that lack robust underlying theoretical support. He argues that we must remember the fundamental difference between the two concepts. Theories, like the laws of physics, seek to uncover hidden, immutable principles of the universe. They aim for universal truth.
And
Models, Derman states, are merely metaphors. They're analogies that describe one thing relative to another. The Black-Scholes model is a wonderful metaphor for option pricing, but it should never be mistaken for a fundamental truth about future price movements. It's a tool for estimation, not a perfect predictor. The danger lies in confusing the illusion, the perfect fit of a model to past data, with the actual unpredictable reality of future price movement. That intellectual humility is the ultimate insight.
we have completed a comprehensive deep dive into volatility, moving from simple definition to complex mathematical critique. Let's briefly recap the essential takeaways for the learner.
We established the necessary taxonomy, the 6 categories that split volatility into backward-looking actual volatility, current, historical, realized, and future, and forward-looking consensus-based implied volatility, historical, current, and future. Understanding the divergence between actual and implied is a key to identifying market signals.
We quantified the math, showing that price dispersion grows not linearly, but by the square root of time based on the Wiener process. This translates a 1% daily move into nearly 16% annualized volatility. We also identified the critical problem of fat tails, that real-world extreme market events are far more probable than our clean statistical models allow.
We looked at the origin, recognizing that volatility is fundamentally driven by market microstructure and the market makers' collective fear of adverse selection, which causes them to widen their trading spreads. We also understood the practical consequences, from the devastating impact of sequence of return risk in retirement to its mathematical role in the Black-Scholes options pricing model.
Crucially, we separated volatility from direction, recognizing that dispersion imposes a constant, often underestimated financial cost. The volatility tax on compound returns due to the mathematical asymmetry of losses and gains. And finally, we ended with the intellectual humility required in this field, reminded by quant masters that even the most complex forecasting models are often only useful metaphors, not fundamental laws.
We spent this deep dive establishing that volatility is a mathematical measure of dispersion, independent of whether the prices move up or down. Now consider this as you go forward and watch the markets move. If volatility is just a measure of how spread out the potential returns are, how much of market behavior, the frantic buying, the sudden selling, the panic, the greed, is actually driven by the emotional response to volatility itself, rather than the fundamental information that caused the dispersion in the first place. It makes you question if volatility is ultimately less a measure of objective risk and more a measure of raw human reaction to uncertainty.
Something profound to mull over until our next deep dive. Thank you for joining us.